Welcome to the Westside Investors Network, WIN, your community of investing knowledge for growth. This is the Real Estate Professionals Investing Podcast for real estate professionals by real estate professionals. This show is focused on the next step in your career, investing. Thank you for listening, and please, if you like our content, rate us on your podcast provider. Just a quick disclaimer, the views and opinions expressed in this podcast are for educational purposes only and should not be construed as an offer to buy or sell any shares or securities, make or consider any investments, or take any other action.
Welcome back to another episode of the Deal Deep Dive segment on the Westside Investors Network podcast. I'm your host, Trent Werner. In this segment, our featured guests will share their unique stories on a specific deal they've invested in. We will dive deep into finding the deal, financing the deal, writing an offer, and the due diligence. Do us a solid and smash that subscribe button, leave us a rating, and share this episode. And now, let's dive deep. Welcome back to the Westside Investors Network podcast. I'm your host, Trent Werner. On today's episode, we are joined by two guests, Bill Kanatas and Ben Salzberg of Self-Storage Developers. Bill and Ben teamed up over 5 years ago now to form a self-storage development company that operates across multiple states. They brought in REIT-level management for their properties, as well as back-end administrative, so they can focus on what they do best, and that's develop real estate and build self-storage assets. Bill and Ben are going to talk about the underwriting process, how to find deals, how they're able to operate across multiple different states, and the benefits from having REIT-level management, as well as tax benefits associated with self-storage developments. Now let's welcome Ben and Bill. All right, we are joined by two guests today on the Westside Investors Network podcast. I am excited to talk self-storage development and maybe dive into some other development questions as well, because I know both of you have experience in this field. We are joined by Bill Kanatas and Ben Salzberg of Self-Storage Developers. Guys, thanks for joining us.
Oh, thank you for having us online here, Trent. I really appreciate that.
Much,
and I honestly don't know if I've had a guest that focuses specifically in self-storage development, so I'm excited to learn more about it and share that with our listeners. Before we dive into the business, clearly there's two people behind this business that make it go and created it. So I want to hear more about your guys' career path and how you got into self-storage development. Ben, let's start with you.
Oh, I appreciate that. So my background, I'm a mechanical engineer education. Graduated from U of I, Champaign, Urbana, grade school. Also went to Oakton College before U of I. Also got an MBA specialized in quality. I'm also a teacher, educated master's in teaching. So my path and focus always was on Six Sigma, Master Black Belt, quality. So I'm a turnaround guy, go into corporations, turn around, and make the company more profitable. I work for companies like Amtrak with the CEO, ADP, Big Abbott, AbbVie. So I help these guys make it more profitable, save the company, and right-hand individual for these individuals. During Amtrak, I was negotiating the air rights with the Boeing building in Chicago because the building was over the Amtrak railway. And I decided, hey, you know what? I love the negotiations. I love real estate, and got in like around 1999 and loved all that stuff. Became a real estate managing broker, managed a lot of different types of commercial real estate projects. And decided, hey, you know what? I think that this is the route for me. You know, quality, engineering, it's all involved in real estate. And so I'm like, you know what? I think that this is my path. And so many years ago, about 4 or 5 years ago, I met up with Bill. Bill's a great individual. And I did some analysis before I even met him. I'm like, you know what? Self-storage is the way to go. And so, you know, it just kind of click in life and find your path. And this is kind of the path that took me to a very sexy product, which is, of course, self-storage. And so it can't get better than that, right? And we'll talk about more about the sexy product. But I want to turn it over to Bill, and he can talk about his kind of background. And by the way, one other thing I want to say before I do that, I am a trustee for Oakton College. I'm still on the board. I was chairman of the college. They have 3 campuses in Des Plaines, Skokie, and Evanston in Illinois. And so I'm very involved with different cities and across even the country because it is a elected position, about 500,000 people. And so I love people. It's all about people, this business. And that's kind of where my focus is, kind of outreaching to the community. So, Bill, take it away.
Wow, I don't know if I can follow that great introduction, but I started my career in financing. So 30 years ago, I bought a mortgage company and did residential mortgages. And through that, we started doing commercial mortgages and started a little commercial fund. And we were financing builders and developers. They were doing, big tracts of land where they're bringing in the water, sewers, streets. And at that time, my partner and I were doing the financing on it. And we said, boy, these guys are making a lot of money and it can't be that hard, right? So we started our own development company, started financing our own deals, and we started with the residential homes. And from there, we moved into retail strip centers. So we built some retail strip centers here in Illinois, also in Florida. And from there, we started doing some office condos, and the smaller ones were for doctors and professionals, lawyers, et cetera. We'd sell them their own condo, and we did that for many years. And recent years, like in the last 10 years, we were building some car washes, and we had a great success with that. And these were the automated car washes, $5 to go through. That's the basic price. And by the time you're out of there, it's probably about $17. Free vacuums. Did that really well for a while, enjoyed it. And private equity came in and they wanted to fuel it with more money and grow it. So it gave us the opportunity to exit at that time. And our operational partners stayed behind to continue to operate these to this day. And we grew the portfolio. When I left, I think we had 4 operational and 2 that were entitled, and we were about to build on them. And today they have about 14. So that brand's doing very well. And Ben and I were talking back, and this is pre-COVID, so we're talking about 2020-ish, and we're talking about getting into self-storage. And we loved it. There's a lot of things about self-storage that are exciting and as Ben will say, sexy. But it's a product that everybody needs, right? Everybody needs self-storage at some point in their life. In our industry, we call it the 4D. So it's death, right? You're going to need to put stuff when somebody dies. Ben will tell you his story with his parents recently. When they passed away, they had to go into storage. You got dislocation. People are moving, or people are downsizing their homes, right? So there's always something that somebody's going to need that product, right? And we're there for them. And we build them in communities that have a need for self storage. So we've been concentrating on that. We develop them nationally. We also love boat and RV storage with canopies. You can put solar on top of that to help, give energy to the facility itself. Or sometimes you sell that off to the grid as well. So we are in self storage for the long haul. We opened up our first facility in 2022. Public storage is operating it. They're doing a great job. And we have a lot more in the pipeline and more under development.
Well, I'm curious. You mentioned the 4Ds, and I only got 2 of them. What are the other 2?
Oh, the 3, I'm sorry. So it's divorce, downsizing, dislocation, and Ben come in with the 4th. Remember
Go
that?
ahead. Go ahead.
I got stumped on that one. So it's divorce, downsizing,
Displacement. It's displacement.
and displacement.
Displacement.
Okay.
Yeah.
Yeah. So I just want to make sure that he knows, it's very important. It's a test. No, it's funny because, we really, with these sexy products, which I call self-storage, we really help the high income investors shield taxes, which Bill can talk to you about, and build generation growth through like Class A storage structures for like kind of REIT acquisitions. And that's kind of what the kind of whole model is all about, right? Is to provide these vehicles, wealth vehicles, to help different populations out. And that's even though we build product, but it's really helping out people, and where to invest in these different products.
And you guys mentioned that you're not just focused specifically in Illinois, but you guys look, sounds like all over the country. How are you finding deals with such a wide net, or I guess land with such a wide net that you're casting instead of focusing on one state or one area, region of the country?
So the one we just found that we have in California, we actually met the owners while we were traveling. And we're always talking to people and looking with different landowners. But we have a big, big network of real estate brokers that we work with throughout the country. So we work with the CCIMs. Both Ben and I also have commercial real estate licenses, but we work with a lot of the bigger brokers that kind of find us deals, to be honest with you. We look for deals that, maybe are not listed yet. We look for pockets. So Ben and I kind of identify the pocket first. Where's the growth going, right? So,
Yeah.
obviously Vegas saw a big growth. You got Arizona, you got Nashville now that has a big growth. So we're not necessarily just following the growth, but we're kind of trying to get ahead of the growth a little bit and see where these new home developments are going. We were just talking to a developer yesterday who's doing several hundred homes in Portland. I mean, several hundred homes in Portland. So our network of people and developers that we talk to, Ben also follows trends. Where's the next Tesla battery going to be made, or where's the
Yeah.
Apple going to go? Where's the jobs being created? All that stuff are trends that we follow, and then we look for pockets in those areas.
It helps because I am a statistician, being a Six Sigma guy, quality. It's all statistics and engineering. And so I have different software, different types of systems set up to analyze to see where these pockets are, where we should go. It's not like we just throw a dart and say, there we go. That's what we're gonna go. We're not like that, and it requires due diligence, but it's more sophisticated to us is that our leg up is my background, right? I can really analyze statistically and probability studies, exactly what we should be doing and how it should be done in these pockets. And so it's nice that we don't have to hire a team of quality guys, since I have been doing it for so many years. But yeah, so that's how we kind of find it, through Bill's network, through my networks, putting it all together, analyzing these processes and systems gives us a good areas to focus on.
So let's use Portland for an example, because I don't think you guys have a project going on here yourselves, right?
No, no.
So, I mean, you said you talked to someone that's developing hundreds of houses here in Portland, and being in Portland myself, I can give you both sides of the story here. But
Sure.
if you talk to someone like that that says, "Yeah, I'm developing hundreds of homes in Portland," what do you guys do with that information? Do you guys then go underwrite a market like Portland, or do you just focus on whatever markets you're already focused on, and just keep that in the back burner?
So,
No, I mean,
so
go
go
ahead, Ben.
ahead.
I would say that's a great question. So anytime we talk to somebody, we learn more about this growth. We put that on our radar. So we then put that in the funnel just to go and start doing some investigations, right? What is the per capita in that area? What is the current population? Where's the population going to be in the next couple of years? What is the income of and the demographics over here? And then what is the competition? And a lot of times you got to call these cities to see if there's anything under review right now. Is there another developer and they're trying to develop self storage? So that's some of the information you don't know. But we also have relationships with public storage and extra space storage. So we would also call out to them and say, hey, we're looking at this area. What do you think? And they're going to say, hey, great area. We're also targeting it. Or hey, we're 2 miles away. We've been meaning to get into this area. So we use all of our resources to look at it. So Portland had a great call with the developer yesterday. It's on my, task. I got a little to-do list of things I want to follow up with, and that's one of them.
And to your point, Trent, though, we go in and look at any restrictive covenants. I mean, if is it zoned, is the city like it, is what's actually the heartbeat, what's going on in the area. Like some areas are like Rhode Island, they hate like some self-storage or some particular like segments of it. How to get not around it, but how to get work with the community to make it a feasible project that everybody loves. Because I'm an elected professional and person, I want to have an outreach with the community. I love people. It's about the people, and so if the community loves it, then it will happen. If they hate it, it will never happen.
Well, and
Absolutely.
then just speaking of community, I guess, or more municipality, all these different counties and cities have such different rules. Do you have specific areas or metrics that you're looking at in terms of the municipality and development rules and costs and those sort of things?
Well, as far as the rule book, I'll take my encyclopedia out in the back because every municipality has, you're right, their own rules and their
Yeah.
own systems and processes. And so first you have to like see if it's a feasible project, and then you have to dive deeper into those rules and see if the
Well,
project will work.
yeah, and I guess again, being in Portland, we're known for having very expensive SDC fees and it taking
Yes.
forever. If you guys are made aware or find out what that side of the potential or the market looks like, is it or do you have any metrics around that side of underwriting a market?
And you're talking specific to the fees or impact fees that you have with the community?
Yeah, like the development cost. Because if you compare
Yeah.
Portland to Idaho, I mean, Idaho, you could probably walk into the office and get a building permit right then and there. But
Yeah.
Portland's going to take you 8-10 months.
I have
Yeah.
to tell you, Trent, Chicago is where we live.
Hmm.
I don't know if it's much difference in Portland. That Chicago is Illinois is very difficult state, you know, and so other states are much easier than ours. I can tell you that right now.
Okay.
Even California, because the fact is that if you understand the barriers of entry and you can look at why these are occurring and how to get over them, then you can put a system and process together.
Right.
I don't want to be like Moses, right? And 100 years from now build a project. But, I definitely, if it's feasible to do and it's within the time and it works, analytically, we'll do it. But if it's those hanging fruits that are just so hard to reach and so much lift, I will walk away. Bill and I will walk away with it because it's not worth it. And it's not just worth it to us, but our investors, because we look at everyone, right? And we want to make sure that everybody is safe and comfortable to do these projects. And so we definitely look at all aspects from zoning to TIF districts to everything that goes to looking to build these projects. And it's very important to do it. And that's why I say I have a lot of statistical background to look at all these different factors. And it is like an encyclopedia because every state and every district is different.
Absolutely. We
And there are
just met
some,
with
by the way, you can walk in the office. Here I am. I'm building this. Oh, here's a permit. Bye.
Yeah, absolutely.
And there are some you'll be like, maybe in 2 years you'll build it.
Right. Well, and I'll add to that point. Ben and I just met with a couple of villages this week, and you really need to understand what is the need for the community. What do they want to see? Right. I remember when we were building car washes, you go to some communities like, no, 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 no car washes. And, it's going to be loud. The kids are going to be out there washing their cars. And I mean, they gave you all the reasons why they didn't want it. But we walked into one community and the mayor said, this is great because I'm sick and tired of sending my police cars and all the municipality vehicles that we own to the village next door because we don't even have a car wash here. He goes, how quickly can you guys start? And he wasn't joking. He actually turned it to the person that was in charge of the permits. The economic developer says, how quickly can we get these guys permits? And she's like, well, mayor, we still have to go through the process of getting it rezoned. He's like, well, how long is that going to take? So he was eager. So you got a community that's eager, right? And they want to put it through the fast track. And you got another community that is slowing you down. But, Ben, being an elected official, he understands also how to talk to some of these politicians because at the end of the day, what do they want to do? They want to do something good for the community. It's about their constituents. They want to get reelected again. And we don't want to swim against the current. We want to be with the villages. We want to help them, right? This is something that they need.
Absolutely.
And now, here's a word from our sponsor.
Get things done while you're on the move. Learn more about working with a virtual assistant through Offsite Professionals. It's a great way to get all the things done that you need to get done. Have freedom in your time and streamline your life by automating your business. Stop spending time on the tasks that you can delegate and start spending more time on your superpower. Call us today at 503-446-3177 or visit our website at offsiteprofessionals.com.
Uptown Syndication is now offering a syndication coaching program for you to take your real estate portfolio to the next level. This is your opportunity to have experienced syndicators, AJ and Chris Shepard, coach you on your way to controlling your real estate investing future. Our coaching program will provide you with the tools and framework needed to begin syndicating real estate in your target market. Go to uptownsyndication.com today to learn more.
Hey, let me ask you, what if tax season was actually exciting? I know, it sounds crazy, but not when you've got the right playbook. At mymoneyworksforme.com, we put together the Pro Tax Strategies playbook that real estate professionals use that you may not know about. You'll learn how to crush taxes with depreciation and rep status, how to stack smart write-offs from the Augusta rule to vehicles, and the ultimate wealth hack, 1031 exchanges and vacation rentals. It's free, it's powerful, and it's waiting for you at mymoneyworksforme.com, because your money should work as hard as you do.
So that's more the underwriting part of this whole business and process. What happens after you've identified a market, got land, and are ready to go?
We go to Home Depot and buy some product.
So
Uh,
we work really closely with we have consultants that are a part of our team that we work closely. They're really not even consultants. They're on our advisory board. They're friends, their colleagues, have been in the business for, some of them 30, 40 years. And we all agree that this is what we're going to go for. Once we agree to that, we sit down with Public and Extra and we say, this is the market. Anybody else going to go in there? You guys, can you manage it? Do you have a team in place? Once we get a green light from one of them that they want to take it on as a management, they run a financial model for us. And that financial model is really the income and expenses and what they think it's how long it's going to take for them to stabilize the property, et cetera. While they're doing that, we're now working with the design team to start putting what the design is going to look like. In Chicago, we're doing one right now that is a full drive-through. And you're going to be able to drive your car through there, unload it, because, we have winter conditions here, right?
Chicago Ridge, by the way.
Yeah, it's in Chicago Ridge, a suburb of Chicago. But in here, we have the weather that we deal with. In Palmdale, California, it's not going to have that. It's going to be a drive up or drive in, but it's a loading bay. And, it's a different climate there. It's going to be a single story versus the 3-story here. That affects your budget, obviously. Your land cost is one big factor, your soft cost and your development cost is a big factor. But then your vertical construction is a big one. So we work with our team to come up with numbers of what the construction is going to look like based on other projects they've done in the area, right? So the one in Palmdale, the GC out there is a guy that builds in California who understands the market, and he'll give us different numbers. Then we take those and analyze it, and then we work backwards. What do our investors need to get? What is the targeted return from them? What does the bank financing look like? Where's the equity going to come from? All those are one big pot, right? If Ben will tell you, we're like an orchestra conductor, right? You have
Right, correct. And we just don't go and build and say, okay, let's like build now, or we love this product. We have those communications open before we even consider to build with the cities. And so we meet with the city. We make sure that the economic development arena in the city understands what we're doing, likes what we're doing. So when everything is teed up, like even the architect prints are being drawn, everything's being done and presented. The city already has relationships with us, so they're not surprised saying that we don't like this, we don't want this. I don't know who you are. We're not like that. And so we love people. So we'll go in and put all of our cards on the table and make sure that everybody really loves this project. And so, and even the people that we work with, the civil engineers, the architects, and those people we really have also very close relationships with. And so if there is a situation, because we have those relationships, we can get over those barriers and solve them, together, rather than, well, that's your problem, not my problem. And we never point fingers. And that's what, problem is with any project. I don't care if it's, development or in a company. People always want to not be offended or call their baby ugly and say, "Oh, I don't want to show my cards." If we all show our cards and we show, what we're, made a mistake or not unsure of, then we'll be able to work together and build something great. And that's what we're all about, is building something great and building an environment where everybody profits and wins. And it's like it's a team. Anything like a football team, soccer ball team, we are a team. And that's how we live. Bill and I live our life as a team.
What? So, I mean, Bill, you've mentioned a couple times extra and public. So, are when you're developing these projects, are they managing it for you, or are you guys self managing?
No, we have a third party manager, and it's one of the major REITs. So either Public Storage or Extra Space at this time.
Okay.
Yeah.
So, but you guys retain ownership of the asset, and then
Correct.
have basically property managers, as if we're talking multifamily, right?
Yeah, it's exactly right. And our philosophy is who can do it better. Sure, can we call it the Bill and Ben storage? It'd be kind of fun, but these guys are the big gorillas. They're the 800-pound gorilla in the room, right? They've been doing this for since the 70s. They know how to do it. They know how to get the people in there. They control the market, and they do a great job. And then our goal is to sell it to them. And who's better to buy it than somebody that manages, right? So if you and I were running, I'm making this up, a restaurant together, right? We know the numbers, you know what it is, and one partner buys the other partner out and says, okay, this is what it is. Same thing with these big REITs. The reason that the third party management was really brought into play for them wasn't necessarily to make money off of third party management, is they're inside. They see it. They control the market. They can see how rates are going up. They see how this store is performing versus this store, and they need to buy more product. They're very, you know, they're very profitable. They make a lot of money. And at the end of the year, they have two choices: distribute it to their shareholders or buy more and grow more. And the more they buy and grow, the bigger and better they get, and the more assets they have. So our goal is to sell to public or extra space, and it could be any one of the other REITs. It doesn't have to be them, but there's
I
more
and I
likely
think I
buyers.
think I think also the question is like, why not multifamily? Why self storage? What's the difference? Self storage, you never hear complaints from your neighbors. The music being too loud, the toilet's broken. I don't know, somebody broke the sink. We don't have that, right? And so it's such a good asset class that it's a machine that runs itself. It really is. And so that's a huge difference. I know that Bill can talk about a lot of the tax benefits of self storage and all about that stuff. But a lot of people, I mean, if you own multifamily, you have to deal with all your people living there, right? And neighbors and fights and rents not paying on time. You know what happens if people don't pay on time, Trent, for our self storage? What do you think happens? We kick them out. I mean, you don't pay a month, they're gone.
Yeah.
We don't have to go through like the court system. We don't have to get a foreclosure. We don't have to do. You don't pay, you're absolutely out of here. We'll they'll like storage wars. They'll auction your stuff off, and the next day we'll run it again. So that's kind of like the difference in strategy that self storage comes into play. But more than that, as far as financially goes, is it's a lot less aggravating, but financially with tax and other stuff, it's more profitable.
And I had this conversation the other day with one of our partners, and he was talking about asset classes where the real estate is the business. And that's car washes, self-storage, laundromat, those types of things where you have way less headaches than when the real estate has a business that operates out of it, if that makes sense.
Yeah.
And I started thinking about it. And one of the questions that I had after that conversation was surrounding self storage and the fact that, I'm used to multifamily. So we have repairs and maintenance all the time. We have work orders coming in, all these things. What does a expense ratio look like on a self storage property? It can't be nearly as high as a multifamily asset, right?
No, the repairs are not that bad. I think last year was probably about $20,000 on one of our facilities. They're not that bad at all. And then these REITs charge you a management fee. They can range anywhere from 4 to 6%. And then the biggest expense, I'm going to be honest with you, is probably advertising. It's not crazy, but they spend a lot of time on advertising, and because they're so big, they're able to, and they have so many stores, they're able to distribute it through all their stores. But that's an expense. Other than that, no, it's, you have one employee, that's there. And in our facility, we would have an employee from 9:30 to like 5:30, but then you would have hours that open up earlier. So with gate access, they can get in there earlier, but you only have one employee. The great thing about this too is, and I've been in so many different businesses in my career, if your manager is sick that day, if you ran this by yourself, right? Trying if this was yours, like it was a laundromat, and your manager said, "I'm not coming." Well, guess what? You're getting in the car, and if you're married, you're telling your wife, "I'm going to work today," right? But the good thing about these REITs is they have regional managers in the area and other floating managers, and they're all in the same system, right? So they know exactly how to operate. It's like walking in from one system to another. There's nothing different. They got the codes. They come in, they set up a computer. It's all done. So yeah, it's a lot better. I've owned multifamily myself, and a lot less headaches. To your point and to Ben's point.
And what because I'm so used to multifamily underwriting and returns and all that stuff. And so when you guys are looking at a self-storage deal, what is a target IRR or AAR? What kind of numbers and metrics are you targeting and looking at?
Sure. So we start backwards and look at what the investor needs. And our typical deal is we pay a pref rate to the investors. We create two classes of share, A and B. We say it. A goes to the investors, B goes to us, the GP. We typically give 50 to 60% to the investors, and anywhere from 8 to 10% on the pref rate. And the reason I'll say 8 to 10 and 50 to 60, we start in the back, and we want to make sure the investors get a 20% IRR or a 30% cash on cash. So if we hit that metric, if we got to give up more of the GP side to get them to 60 or to 65, then we will do that because it has to be attractive for the investors.
Mhm.
And we try to do our first distribution in year 3. And once it's stabilized and cash flows enough money to debt service and cover the bank debt, because they're going to have their covenants for the debt cover ratio. Once it hits that, and the bank's releasing any of our money that we have already as interest reserves, then we distribute that to the investor. So the quicker we can get that in their hands, the quicker or higher IRR that they will achieve. So targeted IRRs for the investors, 20% or higher.
Okay. And like you said, it's typically a pref return is starting in year 3.
Yes. Distribution. No, it starts accruing in the minute we receive the money, distribution in year 3.
Got it. And how long does Ben, go for it?
Yeah. I just want to say, the difference between also multifamily, you're talking about all these, you know, uh, what the probability, the IRs are. But you have to keep in mind too, when you rent out a multifamily home, you're renting it out for 1 year contracts, or maybe 2 at the most, right? And a lease. Public storage, extra space, or any storage, self storage, you're month to month. And so what you're paying now, today, you'll be paying a different price tomorrow
Yeah.
because it's a ramp up. And so, you get in for $1, like, oh my God, I got this for $1. And maybe like 4 months right now, you're paying like $180. And so it's no longer $1. And so that's a big difference. And so that's a huge difference. That's what you're a totally different world when it comes down to self storage and multifamily. Because now you're seeking like month to month rate increases where you can't do with renting a house or a condo, what have you, multifamily. And so I just want to keep that in mind for everybody. It's a different animal when it
Right.
comes down to, all the money that is actually collected by,
Yeah.
the individuals renting. So
Yeah.
important to remember that.
Yeah, it's a service too. Like you said, Trent, you said this earlier. It's a business within the real estate, right? So when I go get my haircut and my hairdresser, charges me $30 for a haircut, and then I go next time and it's 35. Well, it's not like I'm not going to go get a haircut. I'm not going to have my wife cutting my hair for me, right? So it's a service industry. You're providing a service within the real estate. So to Ben's point, the big difference here is you get to raise the rates, and nobody's going there renting a U-Haul, sticking all their stuff in there and moving, not for an extra $5 or $10 a month.
And I'm not talking about like killing the people either with
No, of course
increases
not.
in rent. I mean, that's not my point. My point is specifically that you can adjust the rental rates per month, every month when somebody moves out or somebody's coming in, or even like I own some rental facilities that are not even mine in my buildings. And I'm like, oh, this is great. They just like raise it to get out of me. But I laugh because I know that's the model. That's what the model is. And so I expect that.
And there's like dynamic pricing on storage units now, right? Where it can change by the hour if they're trying to offer these incentives. I've seen and I've seen online where they're literally adjusting and changing the prices by morning to afternoon to evening times depending on what their R&D is
I'm
telling
sure,
them for that day.
I'm sure they're getting that from the food industry because what's what McDonald's and Wendy's, that's what they're all doing. They're
Yeah,
changing, by the time you're coming in. And
exactly.
so, yeah, there, there are so many different models out there that people are doing now.
Right. I guess my other question on the investor side. So a deal start or your pref starts accruing in day one, and distributions are typically starting in year three. How long is it taking to complete development and then stabilize that asset in order to get that distribution started in year three?
So typical construction on the ground up, depending on what month you start and and geography, right? If it's in California or Chicago with weather conditions,
Mm.
it's about 12 months, 10 to 12 months of construction. So the first year, obviously, there's no revenue. By the second year, which is really the first year of a full operations, you're still going through that cash, not cash flow, but the reserves that you have with the lender. And then by year three, I'd say about 6 months into it, you're probably at break even with your mortgage and your taxes. And by the end of year three, you're now starting to hit that debt cover ratio. And it really makes a difference when you open up. So if you're opening up in Chicago, again, if I open up in October, I'm going to have slow months in November, December, January, February. Nobody's moving in unless you got like Ben and I now. This new one has a drive-through that allows people to move more frequently during those months. So it's seasonal as well, right? So more people are moving in the spring, summer, and fall, less in the winter time. If you're around college campuses, parents are taking stuff out of the dorms, they're storing it for a few months. So it really depends on where you're at, but average, I would say by the third year, by the end of the third year, being 1 year you lose for construction and 2 years of full operations, you're able to make distributions.
And what is a debt coverage ratio or requirement on a self storage? I know multifamily, but I don't know what the self storage debt
Yeah,
coverage.
1.2.
Okay, so
Yeah.
similar.
Similar, yeah. I know some lenders have 1.25, but it really depends on the lender. To be honest with you, we're working with a lender that says 1.1, so that's great. It really depends on the asset and the lender.
Absolutely. So I know you guys have some projects currently in the pipeline or in the works. What do you see self storage developers doing aside from completing these current projects? But where do you guys see yourself going over the next 24 to 36 months with the business and the developments?
Ben, you want to take that or you want me to do that?
We look at developing 3 to 4 projects per year. And that's our focus. And we're looking throughout the country. We're looking at locally, but we're throughout the country. We're facilitating different different looking at different sites right now. But definitely growing where we are from right now to then. And Bill, I'm sure can add more to that.
Sure. Well, we're talking to institutional investors that are looking for a bigger pipeline, which we can deliver. So depending on, the partnerships that we forge, will really accelerate our growth. So right now we have the bandwidth to do it. We have projects already teed up. We have things in our pipeline that we've been underwriting for, few months now for 2025, and we have already identified projects for 2026. So it's always great to connect with individual investors. It's always great to connect with family offices, funds, stuff like that. And we talked to a group this morning. I think they got 2.5 billion allocated for this 2025 to put out there. So
Mhm.
we hope to be part of that. We just had another conference call with another company much larger that's looking for a bigger pipeline. So it's great. I mean, it's great to see so much cash in this asset because people realize it's a strong asset.
Yeah, I'm really psyched that we're definitely in the growth model right now.
Absolutely.
And there's so much runway right now. There's a lot of being built. There's a lot definitely storage being built out there and have been built. But because we identified all these different pockets, there's a huge runway still. and that's great for us. So if somebody asks me, where you are right now in your business and the growth chart, I would absolutely say big growth right now. And so I would love to have people even on your show to join us in this growth, because this is a
Absolutely.
huge. This is like a family to me, and I know it's to Bill too. And we love to help people out and to grow the business.
Yeah, and I guess one question that I forgot to ask when we were talking about the deal itself, or the deals itself, or the benefits, I would say, are the tax benefits associated with it. I know you guys are not tax professionals. We'll throw that out now. But just from a high level, because real estate is tax efficient for investors and owners. What kind of tax efficiencies or benefits can you get in self storage as an investor?
Sure, and that's better than a multifamily because you have moving parts, right? You got those doors that go up and down that can break down, or you could take them and move them. So there is a bonus depreciation. In the car washes, it was called an accelerated depreciation, but you have a bonus depreciation. You have a 179D that is really for energy efficiency that you can take as a depreciation. There's solar tax credits and carbon tax credits. So the Palmdale one, we're talking about maybe putting solar on the canopies there. But
Mhm.
we usually hire a firm that'll do a cost seg on that and kind of put together the whole package for our accountants. And we just had one done. Actually, we just delivered to us a couple days ago, and they're basically on a $4 million raise. They're saying that the investor, whoever writes that check, is getting about 25% back on that on the first year on their bonus depreciation. So somebody that has a tax liability in 2026, and they want to put it in self storage, that's perfect place to put it
Yeah.
because you can write that off.
Absolutely. And that's what I mean, my partners and I have talked a lot about tax benefits and efficiencies lately and strategies. And so I wanted to bring that up more selfishly because I'm curious to learn about other
No, I
asset
appreciate it.
classes.
I appreciate you doing that. I mean, we can talk about the taxes and the tips and the 7Bs for property, but but the self taxes, yeah, you can definitely benefit from that. And that's why a lot of people, go with self storage because of that.
Right. And we give 100%, even if we were to keep 40% of the project or 50% of the project, 100% of the depreciation, operating losses, and then the bonus depreciation or the 179, that all goes to the investors. So we didn't even talk about your typical depreciation above and beyond the bonuses. We're not even talking about the operational losses, interest expense, everything that you're writing off, everything's a loss. And that flows to the K1. Now, granted, when you sell it, you're going to recoup that, but the investors are looking today because they have some other capital gain or they have some other passive income that they need to pay taxes on it. They
Mhm.
can park it in self storage, and you're parking it with a REIT, right? I mean, even though Ben and I are not a REIT, it's being operated as a REIT by a REIT. So it's institutional grade, in my opinion.
Yeah, that's awesome. Well, Ben and or Bill, do you guys have anything else to add for our listeners from our conversation today?
No, I think just we have that wealth bus, chugging along. I would love to have everybody to get on our bus before it takes off.
Yeah.
That's about it. If anybody needs to reach out to us, we would love to have them reach out to us. Any questions or thoughts or even opinion on what we just said, that would be great. And Bill can give us our information.
Yeah.
But yeah, I'd love to have that.
Ben, all jokes aside, I'm part of a charity that I co-founded 14 years ago, and Ben's an elected trustee at the college. It's about giving back to people in community. Ben has implemented some really great strategies at the school for job training, right? From
Right.
we were just talking recently with a mayor of a town of the new programs you put in place. And at the end of the day, it's about people, right? We all want something out of life. We all have our families and our children, and we all want to retire one day. So we're trying to provide some opportunity for people for that, and also give back to the community through some of the charity work that we do, and the job training that Ben is creating. So it's really about people. So when we joke
Right.
about jump on the train with us, we want to help people. We like people, and if we can work with good people, it's a great thing. It's a win-win for all of us.
Right.
Absolutely. And how can people get a hold of you if they like to?
So easy email to remember is info at self hyphen or dash storage developers, and developers is plural.com. So info at self-storagedevelopers.com.
Awesome. Well, Bill and Ben, thank you so much for joining us and having a conversation with me today.
Thank you,
Trent,
Trent, for this
great.
opportunity.
Thanks for having
Thank
us.
you. Thank you.
Thank you for listening to this episode of the Real Estate Professionals Investing Podcast on WIN, your community of investing knowledge for growth. We hope that this episode has increased your knowledge and added value to your path to freedom. If you would, please take a second to rate us so that we can get more great investors to interview. If you or someone that you know wants to be on, please visit westsideinvestors.com and fill out our form to be on the show. Thank you again and enjoy your day.